Market is mispricing those businesses.
So the hottest news out there is about Trump's 25% tariff.
I don't know whether we have seen the final outcome of tariff negotiations, but US doesn't have necessary manufacturing capabilities. This is not going to be easy for US economy as well, as you rightly pointed out.
What do you think is going to drive the private Capex growth?
There is a direct correlation between earnings growth and valuations, but there are also times where the valuations kind of go very high or go very low because of the extraneous factors. That's part of the market.
Heard that defense is a highly speculative sector to be in currently, and I've heard that defense is undervalued as well. So what's your take on that?
Most of the segments of the market are trading at a higher valuation than what we have seen in the long term as an average.
What is the one mistake that even experienced investors make?
The excess valuations are really a worry in small caps.
One book that you'd give to every investor out there, that every investor should read. First of all, thank you for this opportunity, for coming here and letting us do this podcast. I'll start off with the questions. First, I would like to understand a bit about yourself. I would like to know how you ended up in the fund management space. If you could throw some light on that, that'd be great.
First of all, thank you, Ashish, for having me on this podcast. Even when I was studying engineering, that's my basic education. I was interested in stock market to some extent. I didn't know the nuances of the stock market, but I was kind of wondering how stock prices move, what are the reasons for those moves, etc. I used to kind of get attracted to those kind of situations, etc. That's when I thought maybe I should explore a career in finance. And after working for a year, just after my engineering, I did my MBA. And post my MBA, I've been in capital markets. I started my career in equity research because that's what teaches you in terms of how to analyze companies, how to analyze businesses, what are the intrinsic valuations of a business, whether the market is mispricing those businesses, because ultimately you are betting on those misprices, right? So that's what I did in the initial part of my career. I spent about 10 years in business analysis and equity research, and then moved on to managing portfolios. So that's a little bit in terms of how I moved into portfolio management.
Got it. So I would also like to understand how has the transition been from being a fund manager to a CIO, and what are the responsibilities that a CIO has that a fund manager doesn't have? If you could brief on that.
See, as a fund manager or a portfolio manager, you are responsible just for managing a particular set of funds or funds. Okay. However, if you are a head of equity or a CIO, you are not only managing a set of funds by yourself, you are also managing the team. You are also giving a broad boundaries and investment strategies for the team, so that there is a coherence in terms of entire organizational investment approach. So to that extent, you will have to manage the money that you are assigned to manage, and make sure that there are clear responsibilities for other portfolio managers to make sure that they also fall in terms of the boundaries that you have set out.
So let's get into the markets. So first, I would like to understand when it comes to the current market dynamics, our GDP growth looks strong, but our inflation is a bit sticky. So do you think the quality of growth is resilient when it comes to the GDP growth?
No, of course. I think all through the COVID pandemic or thereafter, when global economies have struggled in terms of growth, Indian economic growth has been quite resilient, and we have been consistently growing and moving up the rank. Even now, it's been quite resilient, while many of the economy in the world have been showing a lot of headwinds for growth. India continues to still grow at about 6.5% in terms of economic growth, and it's been quite resilient. As far as inflation is concerned, yes, it was sticky at some point of time in the past, fall in terms of inflation trajectory, and that's what has led to RBI reducing interest rates by about 100 basis points. And we do believe that now inflation is well under control. And not only we will sustain this interest cut that has happened, but it has also opened up some room at certain point of time in the future if data continues to show inflation level which is at current levels or lower levels, then there is more room for monetary easing. So I think from a macro perspective, things are quite supportive at this point.
Correct. So you spoke about interest rate cuts. So India already had the rate cuts that has happened. But if you look at the current scenario, Feds are signaling another set of cuts. Do you think RBI is going to come up with another cuts? What do you think is going to be the next cycle? Is it going to be a flat rate cycle or a rate hike cycle or rate cut cycle? What's your view on that?
I think we have seen a very, very sharp cut in interest rates in the past few months. 100 basis points is not a small cut. While that is getting transmitted, the way inflation trajectory has been and how it's expected to behave in the near term, I think clearly opens up room for further rate cuts, but it will be data dependent. I don't think it's very clear at this point of time, but if data continues to support, I'm sure monetary authorities would look at cutting some more at some point of time in the future.
Correct. So currently we have a recovering capex growth, but I feel they are still in pockets. Do you think what do you think is going to drive the private capex growth?
See, the building blocks for a capex growth is essentially there has to be inherent demand in the economy for that kind of a product. Right? Now, post global financial crisis, we did see excess capacity getting built in Indian context. And if there is excess capacity, there is no need for further capacity creation, right? So that's what led to kind of a sluggish investment cycle. Now, when you look at manufacturing sector in India, at an average, the capacity utilization rate would be about 75 to 76%. And usually nobody waits till it goes to close to 100%. At some point of time when it reaches, let's say 80, 85, that's when entrepreneurs will start to look at increasing further capacity. So I think we are almost close to that level. That's point number one. Second is whether the companies have ability to invest in those capacities, right? So if they're struggling with their balance sheet or if their profitability is too low, then those are the times that they will be very cautious in terms of putting more capital expenditure. But now I think there is a healthy a balance sheet situation when you look at average corporate in the country. So that's also supportive that there is ability to borrow money. The third is whether there is ability of the corporates, and the third one is whether there is capacity in the financial system to really go and lend. If financial system is burdened with bad asset quality, then obviously the banks or the banking and non-banking financial companies will have issues in terms of extending that credit to the needy segment. But now if you look at the banking system or the financial system, I think pretty much okay in terms of asset quality. So I think there is ability, there is need, and the balance sheets are also healthy. So overall, I think the stage is set for next round of sustainable investment cycle. But in terms of timing, obviously it's difficult to predict, but over a period of time, gradually it should improve.
Correct. So what's your view on valuations when it comes to mid, small and large? So mid and small, if you look at it, they have recently rallied sharply. But even now, there are some companies that are trading at 70, 90 multiples, PE multiples. What's your take on that? Do you think, is it a good time for retail or be it retail audience like us to enter into it, or should we wait for the right time, or what's your view on that?
See, clearly, after having seen a very, very strong equity market performance for the last several years, especially post-pandemic, the valuations have moved up to a certain level. Across the board, I would say valuations are higher than long-term average valuations. And even if when you look at it from a market cap perspective, almost all the buckets, large, mid and small, are more expensive than their historical averages at this point of time, right? However, on a relative basis, still we believe large caps and in that order mid caps are relatively better off as compared to small caps in terms of valuations and also sustainability of their earnings trajectory, right? If you look at last couple of quarters, the small cap segment has seen a strong decline in terms of earnings growth. It's been a negative growth for last 2 quarters. And as we speak, the results that have been coming through are also showing about 17% year-on-year decline in terms of earnings for small caps. whereas the valuations have continued to move up. So the excess valuations are really a worry in small caps, not so much in mid and small caps, in large and mid caps at this point of time. So on a relative basis, comfort is more on large, less comfort on small caps, and mid caps fall somewhere in between. So as far as investors are concerned, how do they need to allocate? Obviously, it's up to each one's risk profile and return expectations, etc. But for an average investor, I would say tilting their portfolios towards large caps would be a better situation at this point of time. If you are really investing into mid and small caps, given the valuation discomfort, it's better to stagger your investments and also come with a longer term approach rather than extrapolating what has happened in the previous few years as a barometer to expect returns for the next 3 years. So if you come with more moderate expectations, I think it's a good starting point at this point.
Makes sense. So I've heard a lot of fund managers talk about earnings growth. If earnings growth justifies the valuations, do you think it's a correct way to look at it? Do you think if
Yes, I think all businesses are valued based on their ability to generate profits and cash flow over the next a few years, right? I mean, you discount those expected cash flows and you assign a value for the business. So when earnings trajectory is turning around or when earnings trajectory has been very, very strong, that is when valuations also kind of become higher than what they are otherwise, and they are supported by the earnings growth. But whenever earnings growth falters, then people will start questioning that valuation. So to that extent, yes, there is a direct correlation between earnings growth and valuations, but there are also times where the valuations kind of go very high or go very low because of the extraneous factors. That's part of the market. But otherwise, in the very long term, the valuations generally move in line with the earnings growth.
Got it. Talking about valuations, if you could list out, say, if you could give the top 5 sectors that you're bullish on, or sectors that are currently undervalued, that are not in sight of the general audience.
Frankly, I don't think there is any sector or a segment which is undervalued at this point of time, because as we discussed, most of the segments of the market are trading at a higher valuation than what we have seen in the long term as an average. So there are no sectoral picks purely from a valuation perspective right now. In companies where there has been resilient growth or strong growth, there always have been trading at higher valuations. So to that extent, it has to be more bottom-up evaluation of each of those businesses and then making a relative decision in terms of the valuations and making a portfolio. But if you were to just look at the overall market and see where one could be slightly overweight or more dependent, I would say that basket will be domestic businesses. Because while there are headwinds on the global side, you continue to see very resilient growth characteristics for domestic businesses. And within that basket, then you will have to evaluate valuations and the stock specific opportunities and build a portfolio. But a tilt towards domestic businesses will be better, especially given some of the tariff headwinds that we are likely to see in the near future.
Got it. Any particular sectors that are overhyped currently?
See, there are many pockets where valuations are clearly very high. I mean, you in the earlier remark had mentioned how valuations have been expensive in some categories or some sectors, etc. So that's part and parcel of the game. So I would not like to point out any sector as a complete sector to avoid. But certainly there are pockets within our market which are not completely supported by fundamentals. So to that extent, it's a job that portfolio managers will have to continue doing in terms of excluding some of those bets from the portfolio. But it's not that the froth is there across the market and there is a huge risk of valuations or anything. But in specific pockets, in specific segments, there will always be some sort of overvaluation, especially given that markets have done so well in the last 4-5 years. So that's something that you need to keep in mind when you are constructing your portfolio.
Since you're still talking about valuations, I would want to ask about one sector, which is defense. So I've heard two sides of it. I've heard that defense is a highly speculative sector to be in currently, and I've heard that defense is undervalued as well. So what's your take on that?
See, by and large, the valuations in defense sector have moved up over the last couple of years, simply because there has been a policy change at the government level. We are looking at indigenizing most of our defense orders. There is a good growth in terms of what can come as new business for defense companies. There is also a large export market that is available for our defense manufacturers. So from a medium to long-term growth perspective, I think the runway is quite large. There is enough and more in terms of growth for defense companies. However, the valuations also in most cases discount that long-term positive growth trajectory. So to that extent, again, you will have to make stock-specific evaluation and then see how much of those stocks you can have it in the portfolio. I would still avoid taking a very large position in a thematic defense sector. Rather than that, I would keep it more diversified. If there are a couple of stocks in your portfolio, yes, that risk is manageable. But if you are highly into one single segment, which is also not so secular, right? I mean, while the long-term growth is good, medium-term growth is good, there can always be ups and downs in terms of the performance. So to that extent, taking a diversified approach is better rather than a sectoral approach.
Got it. So the hottest news out there is about Trump's 25% tariff on India. So I have two questions to it. First question would be, can US afford this? Second question would be, do you think this is just a noise under the bridge, or is this something India should seriously look at?
See, we'll have to wait and see how this unfolds. I don't know whether we have seen the final outcome of tariff negotiations because there have been so many changes over the last couple of months in terms of what was announced and what finally kept coming in, etc. Yes, I mean, India will have to look at US as a large market opportunity for exports. But at the same time, we'll have to keep our national interest also in mind, right? So that's where the negotiations will kind of converge. However, this is not going to be easy for US economy as well, as you rightly pointed out. If an economy had excess manufacturing capacity, then probably this would have worked, because suddenly instead of importing, people would have started to produce domestically, and you would have seen benefits to the economy, right? But US doesn't have necessary manufacturing capabilities at this point of time, at least, which means that finally they will remain dependent on exports, and that has to be borne by the manufacturer, intermediary, and the consumer, right? We still do not know who is going to take what share, but ultimately there is going to be impact on the consumption within US in many segments, in our opinion, and that will also lead to higher inflation. So definitely there will be some headwinds for US economy. As far as India is concerned, not only the absolute tariff level with respect to US is important, but also on a relative basis within the competing set of countries, where do we stand? That's also very important, because generally if you have higher tariffs, everybody's cost of production is going to go up, right? Or selling into US is going to go up. However, relatively some countries may lose, some countries may gain. That's where I think the relative tariff levels will also be important, and we'll have to wait and see where that settles finally.
Got it. What about the US economy? Do you think it's good to have some exposure towards the US at this current levels?
See, US has always been at the forefront of innovation, forefront of global growth, etc. So having some exposure is definitely advisable. However, we should also keep in mind that over the last decade and a half, US markets have done really well. So to that extent, even there, the valuations are on the higher side. And we also are seeing some headwinds coming in for the US economy. So you will have to balance both of these, but keeping some allocation maybe still is okay.
Makes sense. So if you look at the current scenario, retail SIP inflows are at the all-time high, and even NFOs are getting oversubscribed. What's your message to the new investors out there?
As long as their approach is long-term, as long as they have patience and discipline to invest regularly with a long-term approach, there is money to be made in Indian equities, right? Equities are generally long-term investments. Essentially, you are investing in businesses. No business is going to deliver overnight returns and on a consistent basis. So to that extent, as long your approach is right and you make sure that your asset allocation is properly taken care of as per your risk tolerance levels, I think there is still money to be made in Indian equities.
Makes sense. This is one question I asked to all the fund managers that I talked to. Could you please disclose your personal portfolio allocation, just the percentage wise? How does it look like towards fixed income, real estate, equity? Could give a percentage wise that be?
See, most of our investments have to happen in our own funds because we cannot, not only skin in the game, but we cannot invest in the stocks directly, which are part of our research universe, which are part of our investment universe, etc. But by and large, most of my savings are in mutual funds, and of course, ESOPs and a bit of real estate as well. So that's broadly the allocation.
Got it. So we're at the last segment. Just a couple of quick rapid fire questions, so you don't have to explain and go in detail. Which is the one sector that you'd bet on for wealth creation for the next 5 years?
As I said, currently there is no single sector that stands out on growth or valuations. So it has to be a diversified approach at this point.
Got it. So one segment of the markets that you're cautious about right now?
Small caps are definitely one segment where valuations are high by and large, not only compared to large and mid, but also compared to their own history. So that's where you need to be more cautious.
Got it. What is the one mistake that even experienced investors make?
So I think if you're an investor, you will always remain student of the market, right? You can't avoid mistakes. This is not a profession where you get a bullseye or a 10 out of 10, just like in gymnastics. So what matters is how many times you have been right in terms of your investments and how much money you make when you are right. So cutting your losses early and extending your winners is what you should focus on.
Makes sense. One book that you'd give to every investor out there, that every investor should read?
I would say for any long-term investor or anybody who is starting out to invest in equities, any book that describes the investment philosophies of Warren Buffett would be the one to.
Makes sense. So one investing principle that you would never break?
So managing risk, keeping diversification of the portfolio, that's paramount.
Okay. I think you already answered this. I'll still ask one global investor that you closely follow.
I think there are many, but of course, I mean, I took the name of Warren Buffett. He has done that consistently for a very, very long period of time. I think that perseverance, that consistency is unparalleled.
Got it. So what's your go-to source to stay updated about the markets, about the news out there?
So we rely mostly on our research team because all our investment decisions based on our research, internal research output, and that's key for our portfolio construction.
Any particular platforms that the research team uses?
Yeah, there are multiple information sources, and also we do our own research, right? We can't just rely on what's coming on the platforms.
Got it. So that's it from my end. It was great talking to you. I really wanted to keep it very short. I hope I didn't take a lot of your time. Thank you so much.
Thank you. Pleasure. Thank you.